Manish Prasad, MD and CEO of Institutional Equities, and Atul MEHRA, MD and CEO of Investment Banking at JM Financial. They're joining us from the sidelines of their India conference. Gentlemen, thank you very much for joining me. Manish, since we've never had the pleasure of hosting you, to you first, and also because you're, of course, the main convener of this conference, what's the mood out there? We are at all-time highs. The index has already given record gains compared to any other index. When you invited your various FI and other guests, what is the sense you are getting? Will the market now want to wait for performance? Even a big giant like L&T did not perform. Is the FI community wanting to look for performance, or are they willing to buy, betting that the performance will come?
So morning, Lata. Let me just address that question by taking a bit of a step back to the global scenario, really. Look at what IMF is talking about. Look at the kind of expectations for a softening global economy. Of course, US is the major island over there, which seems to show decent growth. And the other one in possibly the emerging market space as well, with China is taking a bit of a backseat. India, obviously, the growth rates are kind of coming back. They're probably growing at about 5.5%. Expect about 6.5% next year. You have a backdrop of a nice commodity sell-off, really, led by crude and other hard commodities as well. Look at our inflation possibly kind of tapering back. So the sense that we get, the kind of investors coming into our conference, I think people are peering out way ahead than what possibly is possibly in store for the next quarter or so. People aren't focusing really on the quarter. It's a kind of a structural move. I think the business confidence, consumer confidence is also slowly edging up. So investor confidence is quite with India. I think you may have quarterly numbers and a bit of kind of a small corrections, really. But I think the trajectory is pretty well set. Having said that, you'll always see some pullbacks. It may be driven out of global macro, global QEs. That's fine. But I think the trend at the policy level, macro level, as well as I think the business confidence, slowly and definitely edging up. So we are seeing a pretty decent sense from investors as we kind of engage with them through the next 2 to 3 days.
Okay. Manish, hi, good morning. Atul, good morning to you as well. This is Sonia here. Manish, I want to start off with you. What is the most likely scenario in your mind in the next, say, 6 to 12 months? Do you expect a time-wise consolidation in this market if we do get some signs of a pullback? Or do you think it could be a price-wise correction?
So, sense is, if you saw the volatility in October as an instance in point, just to kind of indicate as to what is kind of happening, there are only basically 2 markets that are hitting all-time new highs, right? It's the US market and India. So even if corrections do come about, I do not expect a steep price correction. Consolidations can easily happen in a band of 10%, nothing taking away from that. But those are, in my opinion, price points to actually get into the marketplace in India. You're looking and peering out FY 16 and 17 growth rates coming about, easing of interest rates possibly into Q1 of next year. I'm talking about fiscal. And so by and large, I sense it's going to be a sideways move because of what you're seeing globally. I don't think there's really anything that is born out of India. So I don't see deep price corrections really in India. 10% is a given which you can see possibly in 7-8 days of a correction as well globally. So it's pretty synchronized in that sense, in my opinion. I do not see deep correction in terms of price because markets will held up. It's in a structural kind of a move heading into a multi-year kind of a rally building up because of the economic tailwind and backdrop.
Any thoughts on the expansion of the ministry itself that was announced over the weekend, Manish?
I sense what we are seeing obviously, and as a statement is, well, maximum governance, minimum kind of spread over there. So yes, expansion necessary because I think it started out with a smaller set, needs to kind of percolate down. Atul, would you want to just add in over there in terms of the expansion of the government?
I think right now the expansion which has been announced was pretty much factored in. Some of the names announced on Sunday were pretty credible names. I think market has given a thumbs up to that. We're seeing that in the market. These are all credible people. They come from a background where they have performed, and they are not new to the economy. They have worked in the backdrop, and we continue to believe that they will continue the good job which has been done.
Okay. Well, we did get a lot of positive feedback on Suresh Prabhu himself, since, in his former avatar as Power Minister, he had done such a good job, and now coming in as a BJP, not as a Sena Minister, itself should be seen as positive for a ministry that has been so grossly neglected, railways. But anyway, Atul, more questions to you on actually the divestment. One area where investors have been miffed by the government's performance is the absolute lack of any move to capitalize on this very pleasant phase in the market and divest. Do you think the market will be able to absorb, or the government will be able to go ahead successfully with that 55,000 crores that it is expecting to garner? Will the market give them that kind of money?
Okay. So, Lata, let me give you a perspective on that. We at JM Financial, picking up from what my colleague Manish said, we are very bullish and we are very hopeful that this year we will see about 1,25,000 crore being mobilized from the capital markets. Up till now, we have already seen some 28,000 crore already being mobilized by corporates in various forms. As you rightly said, the government of India, through its divestment program, is planning around $9 to $10 billion of divestment. Not to shy away from that answer, I do not know when will it happen, which one will happen first, but I can tell you the mood is pretty optimistic. If they were to come out with a transaction, I have no doubt in my mind these transactions will be very well received, and you will see probably a record kind of a subscription pouring in for any and each of these divestment which happens. Third, I think the balance is going to be raised by the corporates over the next 4 to 5 months. So we are very confident that this 1,25,000 crore is a target which will be easily achieved. Having said that, I have 2 more points to make. One, we are not seeing corporate India rush in to raise large amount of money as opportunistic fundraising. We are not seeing that kind of move as in now. So probably it's still early days. As the market stabilizes, we will see more and more corporates come in and raise large amount of money. Secondly, interesting trend that we are seeing, private equity investors who in past have invested significant amount of money in Indian markets are now slowly harvesting what they had invested, and they are the largest supplier of paper today, which is why I am very confident that you will be able to see around 1,25,000 crore being raised from the capital market this year.
Okay, that's a big amount. Manish, you speak to a lot of institutional investors. What's the sense you're getting about where the money is going in terms of individual sectors? To play the economic recovery, is there a lot of money flowing into cyclical pockets like capital goods, autos, etc.?
So, Sonia, the sense that is over the past, say, 12 months or more so after May, there has no doubt been a broad basing of investment dollars going across sectors. No doubt about that. But I still sense that given the bit of a drag on industrial production, bit of a drag on investment kind of going back into capex, capital good really not showing the curve, capacity utilization still not at the optimal levels. Money still percolating into the financial space, into the pharmaceutical space. IT services remain to get their dollars. You can see in terms of the sectors which are also hitting new highs. It still is that. One needs to really see the move from Reserve Bank of India, and I think Reserve Bank of India, led by the governor, of course, is doing a fantastic job in terms of attacking inflation. As he calls it, inflation and growth are connected at the hip. So you need to see that really kind of play out, and only then can you see some investment dollars going in. Cost of money has to come off a bit, need not necessarily be immediate, though expectations are built up a little bit in my opinion. But you are still seeing a percolation into the existing private sector banks, public sector banks, NBFCs, pharmaceuticals, IT services, or PSU, I think oil and gas space is seeing an inflow from investors, given what we have seen in terms of dismantling of pricing, dereg in petrol, diesel. So you're seeing a broad basing, no doubt. Mid-cap space is seeing a broad basing. But as yet, I don't think the capital goods space is seeing a major flow, really. It remains underweight in most portfolios. And in my opinion, until I think the credit cycle picks up, one really will not see a big boost, so to say, on the capital space. As you can see from stock performance as well. Nothing great really over there.
Fair enough. Manish, since you alluded to this, there are two potential, accidents for the market. Well, not accidents is a strong word, negatives for the market. It's very likely the governor is not going to oblige with a rate cut in December. It's possible he may not do it in February as well, but we have so much of data until then, it may be a difficult call to take. As well, the growth that we are expecting may not happen even in the fourth quarter. So, even the results that come early April may not be very good. How much can these potentially jack this rally or at least prevent too much of further gains? December 2nd for starters.
Okay. I think interest rate moves of 25 basis points here and there really do not make the long-term business decisions, to be quite frank. So I think a move not in December, not in February, still, in my opinion, okay. The long-term 5- and 10-year business decisions or industry making those decisions are really based on something different, right? Policy stability in terms of what the government talks about, fiscal, taxation, many other things really. So those will be the predicaments, in my opinion, what will really drive investments. Interest rates, I think the focus on inflation is absolutely the critical thing, and that should be the case. And with that, I think as you break the back of inflation, I think growth will automatically come back, and people won't really worry too much about the cost of money, really, interest rates. They will taper off automatically. So in a sense, I think you need to look back into the 70s and see what Volcker did in the US, and then you can probably replicate. It's been too sticky in India for too long now. It needs to be broken down, and then you have consumer confidence, you have business confidence, you have investments. The whole kind of virtuous circle starts spinning, and we get into a Goldilocks kind of a scenario in India then.
All right, that's a very pleasant thing to hear. It'll be nice if the market were to interpret the Reserve Bank's moves in that positive fashion. Atul and Manish, thank you very much for joining us and what should be a very busy hour. We thoroughly enjoyed this conversation, and I hope you all enjoyed it enough to come back again to the channel.